In this video, I want to talk a little bit about corn. Now, I've had several people write into me and say, can I please take another look at corn for them? So the first thing we're looking at is we're looking at this 1, 2, 3 top formation. All right, we need to take a look at this from a downside slide of what we've got. We always want to look at the past history to try and determine what's going to happen in the future, right? So this is our ABC 1, 2, 3 top formation, and we've got a Fibonacci projection off here all the way to the 200% level, and that's right where we're at now. So we're hitting that 200% level right on the money. And I want to show you something else. We're just going to come through and look at a couple more things. Here's a head and shoulders formation. So we see this is the left shoulder right here. This is the neckline. This is the head up in here. This gets kind of ugly right in here where we had a little bit of fight going on with China and the announcements with the tariffs. But nonetheless, we had a right shoulder right up in here. And then we get the neckline coming down here. Of course, the neckline we extend out, and a break below the neckline is generally considered a bearish signal indicating the market has changed from bullish to bearish. This right shoulder, I generally like to see these a little bit more like this. That's kind of more of a favorite way of seeing a head and shoulders. I want to see that neckline on an incline like that. Gives us a little bit early entry, and you can see that the blue lights came in at that same that same location right across there, but we didn't get that. We got this one here. We get what we get, right? And so you see the blue lights coming in there a little bit early against that neckline. But we get the neckline down here. The market breaks down below the neckline, rallies back up above the neckline, and falls once again, which is again very common. And that's less common when we get a trend that's more along this that looks more like this, which is why I like those better. So you get less of these whipsaws in here on the neckline. But anyway, nonetheless, we're going to come in here and we're going to count, measure, set up, trigger, and follow through, right? Count, measure, set up, trigger, and follow through. So the first thing we want to do is we want to count. What is it we're counting? We're counting the waves. We're counting the down waves in this case, since it's a downtrend. So we want to start at the top. This is X, 1, 2, 3, 4, and we're down here at 5, which would give us an anticipation of an ABC, right? And that's probably what we're going to see, something along the lines of sideways market at this point. We're coming into harvest, and of course we also have to take a look at the seasonals. And seasonally speaking, the harvest always, not always, but generally brings us the lowest prices of the market. Why? Because that's when there's the most supply, right? So as we come into harvest, we generally expect prices to fall. Now you can see that coming out here October, 1st of October is when we generally get to the lowest point of our downslide in corn, and then we start to see a little bit of a rally coming up into December, going into the expiration of this contract. So we get a little bit of a rally and then a fall. Now I know that all the farmers right now and everybody's looking for a little bit of a rally in this price. I want to see prices rise. I mean, if you have a field full of corn, you want to see prices rise. So there's the possibility that there could be a freeze, scare, something that could drive this market higher. But for the most part, if we just stick with the natural trend of the market and what we're seeing here with the count and the Elliott wave and the Fibonacci numbers, we're probably looking at possible low coming in here anytime soon. I'm not calling this as the absolute low right now. The software is pointing out that this is the low for the trend for this market so far. But you can see that the blue light has not yet intercepted. So we do not have an intercept on the blue light. Although the blue light hangs back a little bit, the market does have to rally, and then those two intercept to get us an indication that the market's hit the bottom. Now, we generally consider it the bottom of the market in this case when we have 3 drives. Now, that doesn't mean we can't go to a 4th drive. It's pretty common to oftentimes see a 1, 2, 3 formation up here, 1, 2, 3. Count this as 1, 2, 3, and then start the count for the 3rd drive down. If that was the case, we wouldn't count this first wave. This would be drive 1, drive 2. Now I know none of the farmers want to see that, and we're looking at this price and it's like, well, corn can't go any lower than this. We're down here at the very bottom of the barrel right here, but we're really not. If we come back and we look at a weekly chart, you can see that on the weekly basis, we've gone a lot lower than this. All right, consistently throughout the last few years, we've gone a lot lower. Okay, so if I draw my trend lines in there, you can see that we've got a number of hits down here. This is a way more popular price level for the market to hit and turn around on. There's numerous hits in here for the market to have gone lower. We've also got a couple of hits in here where it's still lower down in here. So even though the market's way up here, let's draw a trend line across there. there's still some additional downside potential on here. And back here in 2016, we even had one more low that will count. And there's even some further back, but I'm not going to go back that far. This is far enough for us to look right now. And you can see that we've got a number of different areas of support that we still can hit. If we come in here with a dollar calculator and draw a dollar calculator just from where we're currently trading to this last hit right here, well, we've got a little bit of money in there. There's about $700 in there, $750. If we go to this first area of support I've drawn in there, that's $1,000 just to come down and test these other previous levels of support. And then if we take that one more step, if I can grab that tool, we can grab that tool and we can draw that in there. If we go down to this last one, that's $2,300 in there. But we're going to discount that one right now, and we're just going to play the closer in ones. We got two of them right in here. This is where the market's currently trading. And then we got this the next level, the most previous level is right here. And you can see that if we draw the dollar calculator, and that's about a $675 move. And that's no insignificant move in corn. So that's a nice little move in corn. Corn's a little bit smaller market. It's a little bit easier to trade than some of these other markets that are like gasoline or crude oil or gold or silver. Those are some pretty large markets. Corn's a little bit smaller market. It's easier for smaller accounts to trade. So we can come down here and if we take a look at the smaller term time frame, you can see that the market's just slowly been drifting and then drops and then slowly drifts and then drops. But now we've got a nice little rebound here. We're seeing this little hook down here on the bottom on the 15-minute chart. And you can see it's rallying quite nice today. So the question has to be asked, are we at the ultimate bottom or are we going to see some additional downtrends? If you're hard pressed and you want to trade this market, you want to get in here. If you're a farmer and you own some crop or something you want to hedge, you want to get in on some movement in this market, you want to protect your downside, there's a number of things that we can do. So the first thing I'm going to do is come in here and just take a look at this market. If you're a farmer and you're worried about that additional downside sliding, the best thing to do at this point would be to buy some options. All right, we're going to buy some put options and protect us to the downside. It's just some insurance policies to help alleviate some of the pain of having that market continue to slide lower. Doesn't mean it can't slide lower by looking at it today and what we're seeing on this this trend as this market starts to rebound a little bit. But we are seeing a rebound, which is positive for the farmers. Speculators, we don't really care. We just want the market to move one direction or the other, and we want to be right in our selection, right? So where the market's starting to look like to me, we're coming down here, and there's the possibility this could be the bottom. Of course, we've called that several times during this sideways trend, looking for this market to possibly bottom out at the same time as this previous low right in here. This might be that point where you might want to consider looking to take a long position, but hedge your position to the short side because we, seasonally speaking, do have some additional downside potential, and we don't generally see this market start to rally up out of this thing until October. So if we continue to slide down, we want to make sure that we're hedged to the downside if we're taking a long position. One of the best ways to do that is with a married put. And I call those soft stops. You've probably heard me talk about them as soft stops. So let's come in here and we want to talk a little bit about a soft stop. The first thing we want to do is we want to start looking at options. Which option do we want to take a look at? So we're going to come in here and take a look at an option. And we're going to try and decide, well, we want to have a decision made within the next couple of weeks, right? So maybe 2 to 3 weeks. I'm going to look at the 16-day options. They deteriorate very quickly, and we have to remember that because we are down in that last 30 days of an option, but this is just an insurance policy to the downside, so we have to consider what we're going to do here. If we're going to take a long position at this point, and we're going to go long with the farmers are already long, right? So we're going to go long with the farmers and anticipate a rise in price. What we're going to need to do is we're going to buy a contract. And then we're going to hedge ourselves with an option. Do the same thing as a farmer. Then we're going to then protect ourselves to the downside with some insurance. Now, if we think the market's going to continue to slide lower, we would do just the opposite. We would take a short position in the market and we would buy some call options as insurance to protect ourselves. So let's do one of these. Let's do a couple of these in here and make it real simple. Let's just come in here and let's say that we want to be on the side of the farmers and we want the market to rally. So what we're going to do is we're going to come in and we're going to just buy. Let's just buy one contract to start off with. Now you can jump into this with as many contracts as you want, but I like to keep it simple and we'll just start with one. We're just going to come in here and we're going to buy one. All right, so we bought one. We're long one contract of corn. If we come over here to the key, you can see that equals 5,000 bushels of corn. So you're long 5,000 bushels of corn. You went out and planted 5,000 bushels of corn in the field, and that's what you're thinking about right now. Okay, so you hold the corn, you're long just like a farmer would be. But if that market continues to slide lower, what are you going to do? how are you going to protect yourself against a downside slide? Seasonally speaking, we don't get a reversal until October, but yet we're down here bouncing against this lower previous support level in anticipation of a crossover of that blue light and the third drive pattern down, looking for a rally. So if that's the case, we're going to come in here and we just want to protect ourselves. Now we can do that in several ways. We can come over here and we can just put in, let's come down to a shorter term time frame chart, a little easier to see. Let's go back to that 15-minute chart. So we can just come in here and put a stop. Very easy, right? We can come down in here and we can drop a stop on here. And we would do that with simply 1, just like that, and we're good to market, right? We're protected to the downside, and that's the simplest and easiest way to trade this position. Now, what we're doing here is we're taking a risk. We're taking a risk of about $200 in there. So that risk is that if the market comes back and touches and knocks us out, we're going to lose $200. All right. So let's think about that for a second. Could we use an option in a little bit different manner? We can come in here with an option and use a soft stop is what I call it. So we're going to come in here and we're going to price out an option. And I'm looking at just the 16 days, which is about 2 weeks. So a little bit of insurance on the downside. Now a 2-week option in here costs $318. Our stop was at $200. But we can come in here and put a soft stop in here, and if the market starts to fall, we don't just lose the money off that we would lose off a stop. The option would start to gain money as well, right? So there's an advantage to having a put option in there. If this market continues to fall, yes, we lose money at a 1-to-1 ratio with the long position, but our delta on the call option, on the put option for $328 has a delta of 0.48. So it would start making 50 cents for every dollar that we are losing on the contract. So there's an advantage to that. It's more of a better insurance policy where it actually pays your premium back and just stops you out the $200 loss. So if we come in here and we put that in with just a single option, we're covering 50% of our downside potential, right, for the next 2 weeks. What if we wanted to be 100% downside potential covered? Well, we could buy 2 of those, right? We could buy 2 of them, and then we would have a 48 times 48. That would be nearly 100% when we'd be covered to the downside 100%. Because an option at the money, when you buy it, generally only has a 50% recovery rate, a delta of 50. So if you wanted a full insurance policy to cover the downside to 100%, you would buy 2 of those. Okay, so now if we come in here and let's just go ahead and let's buy 1 initially. We're going to come in here and we're going to buy 1, and we're just going to do that right at the market, fill that order, and we've got our insurance policy placed right in at the money. That's all there is to it. You now have your insurance policy to the downside, and if the market starts to fall, you're going to make 50 cents for every dollar that you lose on the upside. Okay, so that's called a married put. Married put, or I call them soft stops. It's a soft stop, meaning that the market can move against you and you're not going to get stopped out, but you're also not going to lose as much money as you would if you were just trading with a hard stop. So that's a nice little strategy that we can put on here or at any time in the market whenever you come to a decision point in your trading strategy. And again, if you wanted to be 100% protected to the downside, all we would have to do is just do the exact same thing one more time. We just come in here and we buy 1 more and we place our order. And we now have a complete, what I call a perfect hedge as opposed to a hedge. A hedge would be a single option at a delta of 0.48, and a perfect hedge would be 2 options giving us a delta of 100. Therefore, if the market falls, we basically make as much money on the downside as we would be making on the long side. If the market continues to rally, we can then liquidate off one of those positions, come back down to a delta of 0.49 or 50, and then let that market continue to run. And once we're happy with it, we can go ahead, and if the market continues to run, we can liquidate that other insurance policy. But the market only has to run. Let's do a little break-even calculation per option, so that's $337. So the market has to run $337 to pay for one of those options. So just to pay for that insurance policy, the market has to go up to about that distance. So that's the little box that we have to draw for ourselves when we're doing this. So we want that market to rally above that point to pay for one of these options. Now we've got 2 of them, so we're going to be in there, closer to $700. So we would have to draw this box up to $700 to pay for those positions. And then once we paid for that insurance premium 100%, the options can't lose any more money than we paid for them. We paid $700 for the premium of those 2 options. Once the markets move that distance back in our favor, $700, those premiums are paid for, and everything beyond that is going to be profit. Okay, but if the market slides and starts to fall to the downside, we can lose as much money on the long position that we have in the contract as we can make in the option on the downside. So that's going to be a 1-to-1 ratio. So we're going to have to watch that again. It's protecting us to the downside. We don't have any profit potential to the downside because of our position unless we liquidate our long contract. If the market starts to fall hard, we could hang on to our put options and get rid of the contract and let the put options move into a profitable territory to pay for the losses. So we always want to take into consideration that we're looking to pay for the premium of the options that we bought, pay for the insurance policies, or if we're in wrong and the market starts to actually fall, we're going to liquidate our long position and let the options pay for the losses. Okay, so that's just a quick look at how we want to handle corn.
The number one question I get when people watch my videos is they want to know what software platform I'm using and what indicators I'm using. First and foremost, if you come to our website, tradementors.com, you'll notice that we have a section here called Tools for Traders. If you click on Tools for Traders, the software tools in here are listed. And you can see the recommended trading tools. We have the live trading platforms that we use. These are from Track and Trade Live Futures, and Track and Trade Forex. If you click these more info buttons, you can find out more information about the platforms we're using. I also use a plugin to the live futures version that is called the Bulls and Bears. That's the Bulls and Bears is what turns the price bars red, yellow, and green and gives me the Elliott Wave blue light system. And so that's a plug-in into the live version of Track and Trade, and it works on both the live futures as well as the live Forex. Now, some research tools that we love and that we have here listed as well are the Trade Miner tools. This is Trade Miner for stocks, futures, and Forex. This is one of the research tools that helps us identify the fundamental nature of markets. And then, of course, we have Newsminer. Newsminer is the current active information, scours the internet, tells you what the current news is on any given stock, future, or Forex, and then ranks them, which ones or which markets are in play. So again, if you want to have a little bit of information about the tools that we use here at Trade Mentors, come to our website, www.tradementors.com, and click on the Tools for Traders button.